Hi, it's Ray from CappThesis. Today we'll be talking about what the heightened two-way volatility we saw in April means for the market going forward. We'll also look at why the S&P 500 is at a critical spot right now. At the end, we're going to break down why and how there are both potential bullish and bearish chart formations in play for the S&P. So let's talk about heightened two-way volatility first, and we measured that in terms of number of 1% moves both up and down we see go through on any given day. And we track this, as we know, every month to get a sense of when things could be changing. And all along the way from October until March, there's really nothing to be concerned about from this angle. Only had 1% loss at the most through March. And at the time, we also had a lot more 1% gains. We didn't have a lot of either of them, which is what we want to see, but of course, more 1% gains than losses. And so right now, through April, we've had 6 total 1% moves, 3 up, 3 down. Again, nothing came close to that since October of last year. We know that October was the end of that corrective period, where at the very end, we had the beginning stages of the rally that's now in place. So the concern is that, does this mean that we'll have more of these? And at the very least, that means we have a two-way market as opposed to what we've seen in the past. Now, as the market has come back through last week, we had 2 straight, or we should say 2 1% gains in a calendar week for only the third time since the October low. And coincidence or not, they happened around the same time of earnings season, both prior times, when February 1st and 2nd, right, as the high growth names were reporting. And also at the very beginning stages of this, October 30th through November 2nd, we had 3 of them in 4 days to kickstart all of this. And so needless to say, the market did okay following it in the weeks and months that followed. In particular, strong week right after, both times as well. Of course, this time is different. We're basically 6 months later in the cycle and also a lot higher, especially compared to what we have back here. So the concern is that because of those things, does it mean that we need more corrective action than just the 6% sell-off that we've seen so far? And so the S&P is in a key spot for a few reasons. One of the ways we look at this is just in terms of how it is in related to its key moving averages, and are those moving averages sloping lower, and also the indicators. So as we have highlighted here, we see that it's testing both its 20-day moving average and its 50 after the bounce. Now, we knew we were going to get some sort of reflexive move, which we now have, and it's a matter of what the S&P does with it at this point. And this is really the first test of that in a very big week, right? As we know, with the Fed, big earnings, and the jobs report coming at the end of the week. And so from an indicator perspective, RSI, the 14-day RSI, bounced from nearly oversold territory back to the midpoint. We have to get back above it because we're really much different so far than what we saw all the way through here, where it stayed above the midpoint and oscillated between overbought. Where in the previous time, right, from the end of July through the end of October, couldn't get much above the midpoint. That's obviously something you see in a stressed market. And willingness percent R, maybe not as popular, but a very good one to track because it doesn't take that much to move it. And that's even more impressive considering what happened before, where it stayed very close to overbought and only had oversold one time those few days at the beginning of the year until recently. And if this can't even get overbought, it just shows that the bounce has been weak. Another thing to look at here is that the 20-day moving average rolled over the 50 back here at the end of August, even as the S&P was bouncing. That bounce failed, again, even above those averages, and then rolled over. Same type of things happening now, where haven't quite seen the S&P get through both of those moving averages, but the 20-day is rolling over the 50, and that can only get corrected with an exaggerated move to the upside, which we saw, of course, here in November. And so in terms of breadth, again, different ways of looking at it. We don't have the cumulative advanced decline line here, but if you put that next to the S&P 500, it looks very similar. So don't really get a signal either way from that angle. One of the things that has been instructive, though, was looking at this chart, S&P's 500 components versus their respective moving averages. In particular, the 20-day down here, because as things started to really get bad, as the April sell-off continued, we noticed that there were less than 10% of the S&P 500 components trading above their 20-day moving average. If that lined up with the worst, the extreme lows going back even to the summer of 2022. Even if those rallies failed, we did notice that when you see that number start to rise up from an extreme low, they did coincide with at least multi-week bounces, right? And so that's happened so far. Again, the question is, is it going to be more like what we saw at key lows, key trading lows, or just failed rallies? And one thing we'll be looking at in terms of percent above the 20-day and also the stocks above their 50-day moving averages is, can we get back above levels that we saw them fail at back in August, September, and October, right around 50, 60% regarding the 50-day moving average, and also with the stocks above their 20-day, right there, right now. And so we can potentially see a lower high in these breadth indicators as it coincides with a lower high with the S&P 500 itself. That would be worst case scenario, of course. Now, in terms of the 200-day moving average, still in the 70s. And one of the things we pointed out as a potential positive was that it only got to, low of 68, 69%, even at the April low. That's good for now. That's what we want to see continue. Now, zooming way out of this, same thing, same indicator down here, percent of S&P 500 stocks trading above their long-term 200-day moving averages. One thing really stands out is that we never got that 90% level where all these really strong moves from the low of 2009 all hit and really held for months at a time. So still haven't got to that extreme yet. Now that could be perceived as a negative. Markets near 30% move in less than 6 months, could even get 90% of its names above there. That is something to consider. But also, let's also recognize the fact that from late 2014 all the way to late 2020, there was never a time when we had more than 90% of the S&P 500 stocks trading above the 200-day moving average. Yes, there were some big downturns in there, the COVID crash and fourth quarter of 2018. But along the way, there were some really strong moves as well from late 2016, as we know, all the way to 2018 and 2019 too. So is this something we want to see happen if the market continues to rally? Of course, as the more stocks that trade above the long-term moving averages, the stronger the foundation, but clearly not a necessity for an uptrend to continue longer than it has based on what we've seen, again, from some of these strongest periods over the last 15 years or so. Another thing we're looking at closely, again, is the number of new 52-week highs. And so this is just a chart showing that going back to just about a year's worth of price data here. And we have highlighted the 4 days that we've had more than 100 S&P 500 stocks make new 52-week highs along the way. And we had that initial pop in mid-December. We know that was followed by basically just a month worth of sideways action. So we didn't see it again until March, but then had it 3 separate times in March. And as things started to roll over, not since then. And so right now we've had a few days with above 20. Again, not high at all, but off of the low here. One thing to consider is to go back and look to that period we talked about before from August to October, where the initial rallies, the failed rallies, the ones that could not get back above previous highs, all topped out with less than 30 S&P 500 names making new 52-week highs. So if that continues, of course, that's going to tell us that this market is just tired and it's not going to be able to have a substantial rally without more corrective action. Something to consider going forward. Now, coming into today, there were 80 S&P 500 names within 3% of their 52-week highs. So not too far away, over 130 others within 5%. So that just means if we could get some reaction to some good news again in the next week or two, that number could really change quickly. If it doesn't, it will just tell us that we need more time to, at the very least, digest what has just gone on. So looking at the daily price action, no surprises as things would come back. You see a lot more blue on our chart, there are those two 1% gains last week. We've closed above the midpoint now 6 straight days, which is the longest streak since 7 in a row to begin February 3 months ago, just about. And as the market was coming out of earnings season, or out of the meat of earnings season, that is. And then we just need to see more new highs here. Pretty good run here, 7 out of 8 days with positive breadth. Nothing extreme, but still more positive than negative. One thing that stands out is just how the leaders and laggards have stacked up over the last few weeks, especially with comm services being both the laggard and leader 4 times over the last, say, 6 days here. And all because of earnings, right? This was Netflix when it was down, of course, Meta, and then Alphabet. And so still trying to find its footing. It's a very important one, as we know, because of the big names in there, and also because it's done a very good job holding close to its highs and not enduring that much pain on the downside, and held up much better than the NDX, than XLK, and even the S&P 500 during the pullback. So seeing that maintain its relative strength is going to be important for the market leadership going forward as well. And so let's talk about patterns now. First, let's look at the live patterns through Monday, April 29th. And so we come into the day, again, 6,100 is the big one. That's been in play since the breakout on January 19th. And now still 6% away from this breakout zone, 4,800. Still has a lot of back and forth it can endure and keep this upside target intact. And really all on the way, as we were talking about. The best thing about this breakout is that it has earned the ability to do this, which has now been doing for most of April. However, we also have smaller ones in play. As we can see here, most recently, a cup and handle pattern, intraday basis, a 2-hour chart, and also a bearish one, which are right here. And so this is when it becomes somewhat tricky, and also it becomes frustrating because you can see whipsaws on both of these before decisive trend is identified, where we came very close, we talked about last week, to achieving that downside target on the bearish side, 409.44, but did not, and then closed slightly above the last breakdown zone. On Monday, we kept this one in here because we just know how this can move so quickly. So far, this continues to be alive, where it took a very big effort on Friday, come back on Thursday, and then Friday last week to get this bullish pattern triggered, but very close to the breakout zone and could easily be negated as well, especially as we head into May. And as we know, more key data, both macro and micro, coming out. But this is what happens after, say, an uptrend or downtrend line is broken. You have a lot of infighting, and we see that resulting in these short-term patterns being in play. And we can also see that, from a longer-term point of view. Now, you may have seen, in terms of potential patterns, we cited this chart, or this stack of 2 charts on X, and it got a lot of feedback, both bullish and bearish, as you might imagine. And we took the liberty of coloring the potential bullish formation in blue with the upward sloping 200-day moving average, right? Shows you that's bullish, where on the downside here, this potential bearish pattern in red with the flattening out or almost rolling over 50-day moving average. And so needless to say, bulls will see this and understand it's just a potential blueprint for a continuation pattern. And yes, an inverse head and shoulders pattern can be a continuation formation. And we know that this is not going to hold exactly to this path. We started talking about it actually on April 19th and the day before for CappThesis clients, saying that we knew this is going to veer from the path at some point, but we'll keep on talking about it for as long as it remains in play, which it has so far. And so at some point, it's going to look different, most likely. Now, the bears will look at this, obviously call it invalid, and look at this and believe that this is a valid top, or at least potentially, because as we can tell, 1 or 2 strong downside reactions to some data this week, and you can easily get back down to the lows from back down here. But in reality, there's one truth, and that is the fact that the only difference is your bias, right? People that have been bearish We're waiting for a top to form. This could potentially be one. Bulls all on the way have been riding this, and every consolidation has been just there to be a continuation pattern to eventually take advantage of. So as we can tell, either one of them could be right. But the whole point of this exercise to show everyone that we cannot discount anything, whether we disagree with what the pattern looks like or what it actually could mean. You have to respect the fact that both are potential options and not ignore any of them. That's what we have for today. Check out these videos and subscribe. I'll talk to you next time. Thank you.